Hey everyone, welcome. So today we're going to dive deep into one of the most famous candlestick patterns out there, the bullish engulfing. Now, a lot of traders think they've got this one all figured out, but as we're about to see, there is so much more to it than meets the eye. So you see this massive green candle, right? It just swallows up the red one before it, and your first thought is probably, okay, this is it, time to buy. It looks like an absolute undeniable signal that the bulls have stormed the castle and taken control. But is it really that simple? Or what if it's actually one of the biggest and most common traps in all of trading? A pattern that looks incredible on the surface, but more often than not leads to some really frustrating losses for anyone who jumps in too fast. Well, that's the big question we're tackling today. All right, so let's get into why this pattern can be so deceptive. It's not that the pattern itself is useless, far from it. It's that you see it so often, it's just incredibly easy to trust it more than you probably should. So get this, out of 103 different candlestick patterns that were studied, this one, it's the 12th most frequent. That's a huge deal. And that high frequency is exactly why it can be so dangerous, because you are going to see this thing pop up on your charts all the time. And that's exactly where the trap lies, because you see it all the time. A lot of traders just act on it without ever thinking about the bigger picture. This constant appearance means a ton of these signals are just market noise, not real reversals. And that, of course, leads to failed trades. Okay, so to avoid that trap, first things first, we have to be 100% sure we're actually looking at the right pattern. So let's break down the precise anatomy of a true bullish engulfing signal. It really breaks down into 3 simple steps. First, the market has to be in a clear downtrend. Then you see a small, bearish red candle pop up. And finally, here's the main event. A big, powerful green candle that completely engulfs the body of that little red candle before it. You need all 3, no exceptions. All right, so you've spotted the pattern. Check. That's the easy part. But now we get to the most critical part of this whole thing. I'm talking about the 2 golden rules that separate a really high probability setup from just another potential failure. And this really shows the huge difference between how a beginner and a pro look at this. The common mistake, you see the pattern, you smash that buy button. But the pro, they've got a checklist. They're asking, what's the context and where's my confirmation? So let's dig into that first rule, because context is everything. I mean, everything. This pattern only really has power when it shows up after a long slide downwards. If the market's just chopping around sideways, that bullish engulfing pattern means, well, it means pretty much nothing. You've got to see that clear downtrend first. And rule number 2, this one's all about speed. You need immediate confirmation. That means the very next candle. Not 2 or 3 candles later, the very next one has to close above the high of that big green engulfing candle. If it doesn't happen right away, the pattern is dead. It's invalid. You just got to throw it out and look for the next setup. Okay, enough with the theory, right? Let's put these rules on trial. We're going to jump into some real-world chart examples from our source material and see how these 2 golden rules actually hold up. All right, first up, a classic failure. So at point 2, you see it, the bullish engulfing pattern forms, but let's run our checklist. Rule 1, was there a downtrend? Well, if you look back at point 1, not really. The market was just kind of going sideways. That's strike 1. Okay, rule 2, did we get that immediate confirmation at point 3? Nope. The next candle couldn't even break the high, strike 2. So what happened? Look at point 4. The price just went nowhere and then rolled over, a textbook trap. This table really lays it all out for us, summarizing 3 examples from the source material. Look at example 1. The rules were ignored, trade failed. Simple as that. But then look at examples 2 and 3. In both cases, the pattern showed up in a real downtrend and got that immediate confirmation. And the result? Both were successful trades, netting moves of over 6%. It's pretty clear, right? And this chart just makes it super obvious. By sticking to those 2 simple rules, the trader in these examples basically turned what can feel like a coin flip into a strategy that worked 2 out of 3 times. That's what I'm talking about, the power of context and confirmation. Okay, now for what might be the biggest secret of all. We've talked about how to trade it, but what's the best way to even think about this pattern? This is where it gets really interesting and kind of counterintuitive. So here it is, the big secret. The bullish engulfing pattern is not a sign that some massive new bull market is kicking off. Nope. Its real strength is as a short-term counter-trend signal.
In fact, it actually works best in a bear market, signaling a temporary bounce. The data even shows its performance ranks 14th when it's used exactly this way. And hey, don't just take it from me. Here's a quote from the source expert, Matt Stevenson. He's been trading for 20 years, and he says it himself. He never really thought of this pattern as being best in a down market. Kind of wild, right? It totally flips how you should view this pattern. It's not about a reversal, it's about a bounce.
And, that really leaves us with one final question. The bullish engulfing pattern seems so simple, so obvious on the surface, but its real power is hidden. It really makes you wonder, what other obvious signals out there are we all completely misreading?